Imagine you and your friends are throwing a massive birthday party. Instead of one person buying the food, drinks, and music all on their own, everyone puts in a little cash to create a shared budget. That exact pooling mechanic is what drives a financial fund. By grouping your money with thousands of other investors, you can collectively buy into an expensive, diversified basket of stocks, real estate, or bonds. The primary appeal here is delegation. You get to own a tiny piece of hundreds of different companies without dealing with the stress of researching, buying, and balancing every individual asset yourself. But if you choose the wrong structure for that pool of money, you expose yourself to hidden management fees and structural risks that will quietly drain your returns over time. If you try to research this online, you'll immediately hit a wall of jargon. Finance influencers push ETFs, your HR department defaults to mutual funds for your 401k, and financial news constantly reports on hedge funds. We aren't going to try and guess which specific stocks these funds should buy. We are going to look under the hood at how these different vehicles are actually engineered to operate. To sort them out, you only need to evaluate two structural trade-offs. First is management. Are you paying a human to actively pick stocks, or is a computer passively following a list? Second is liquidity. Can you trade your shares instantly in the middle of the day, or do you have to wait until the market closes? By plotting the four major types of funds onto this specific grid, we can expose exactly how they function. This visualization strips away the marketing hype. It forces you to see the precise compromises you are making when you hand over your capital. Let's start in the bottom left quadrant with index funds. These sit firmly in the passive end-of-day category. Passive management means there is no highly paid analyst trying to guess which companies will win. The fund simply replicates a predefined list, like the 500 massive companies in the S&P 500, and buys them automatically. Because a software system handles the execution, your annual fee, called the expense ratio, is incredibly low. You are often paying just pennies on every $1,000 you invest. The trade-off for those low fees is how your trades are processed. Index funds use net asset value pricing. You cannot buy or sell a share and lock in a specific price at noon. If you place an order at 11 a.m., your order sits pending. It will only officially execute based on the total value of the fund calculated after the stock market closes at 4 p.m. This low-cost, hands-off approach has an incredible track record over decades, which is why legends like Warren Buffett recommend it for the vast majority of everyday investors. That end-of-day pricing delay works perfectly as a behavioral guardrail. It prevents you from reacting to midday news and panic selling your retirement. Moving over to the bottom right quadrant, we find exchange-traded funds, or ETFs. These share the passive trait of index funds, but they provide intraday trading flexibility. An ETF can track the exact same passive S&P 500 index as the fund we just looked at. The structural difference is entirely in the packaging. By trading directly on the stock exchange, an ETF's price fluctuates second by second, meaning you can buy and sell it exactly like you would an individual share of Apple or Microsoft. This wrapper makes them highly accessible. You can log into any standard brokerage app right now and buy an ETF, usually with zero commission fees. ETFs offer a highly efficient blend of broad diversification and real-time control. You just need the personal discipline to hold them long-term, rather than day trading them. Up in the top left quadrant are mutual funds. Here we introduce active management, but we are back to end-of-day execution. Active management involves hiring a professional fund manager and usually an entire team of analysts to handpick specific stocks. Their explicit goal is to beat the baseline market index. Paying humans to research companies requires a premium. Mutual fund expense ratios routinely run from 0.5% up to 1.5% or more, billed every single year. This graph illustrates the impact of those fees. Both lines represent a $10,000 investment over 30 years. The line with a standard 0.03% index fee grows aggressively, while the line burdened by a 1.5% active management fee drastically eats into your compounding returns. This is known as fee drag, and the historical data is brutal. Over a standard 10-year period, the vast majority of these actively managed funds fail to consistently beat the passive S&P 500 index. On top of that, mutual funds utilize that same end-of-day NAD system. Your trades only clear once a day. When you buy a mutual fund, you guarantee a high fee structure for a statistical improbability that the manager actually outperforms the market. Finally, sitting alone in the extreme top right are hedge funds. This quadrant represents hyperactive management and highly complex intraday trading. You won't find these on a standard investing app. These are private pools of capital, strictly restricted to wealthy, accredited individuals and massive institutional investors. Hedge fund managers have the regulatory freedom to use aggressive tactics. They borrow money to multiply their bets, short sell failing companies, and utilize complex derivatives to generate huge profits. They also utilize the infamous 2 and 20 model. They charge a flat 2% annual management fee on your total money, plus they take 20% of any profits they generate for you. They exist to force high returns, regardless of whether the broader stock market is up or down. But extracting those returns requires accepting extreme volatility, locking up your capital for years at a time, and paying massive fees. Now that we have the mechanical constraints of each fund mapped out, we can apply this matrix to your specific financial situation. First, are you an accredited investor with millions in capital who needs aggressive, uncorrelated returns and doesn't care about high fees? If so, look into hedge funds. If not, are you specifically willing to pay a premium for a human manager to try and beat the market in a particular sector? That points you toward mutual funds. For the vast majority who want low-cost, passive market growth, your decision is purely about control. If you require real-time execution during the trading day, use ETFs. If you don't mind end-of-day pricing, stick with index funds. No vehicle is universally perfect. You have to align the fund's structural realities with the size of your portfolio and your own behavioral habits. If you want a strategy you can completely ignore for 20 years, basic index funds will protect your wealth from your own worst impulses. If you prefer tight execution and flexibility, ETFs give you incredibly cheap access to the entire global market. If you do choose active management, you have to ruthlessly audit the expense ratios because fee drag is the silent killer of compound growth. Ignore the acronyms, control your costs, understand exactly when your trades execute, and let time do the heavy lifting.